Problem with doing that is I now can't see the screen for Room PC for when I want to record. What have I now managed to do? So that's
I guess that will be Room PC.
Yeah.
Extended output. If it's extended output, it should show up.
Yeah.
But and then laptop.
No, so I unplugged my laptop.
You unplugged it? Oh,
Yeah.
okay. In that case, it will be the desktop.
Yeah. Okay.
So where's the desktop? That's great. There you go.
Okay. Cool.
But and that's it.
All right. And in terms of breaks, what's the deal with breaks and
I
bits?
think it's about 1 hour into the lecture a break.
Yeah.
Another 5-minute break. It's like a 10-minute break.
Okay. Cool.
That's really up to you.
Yeah.
And I have the attendance code as well, and you can share that maybe halfway through the lecture.
Okay. Yeah.
So you just sent me another mail, said record after the introduction and stop at the breaks.
Okay.
Okay.
So you're gonna have to remind me. Is it gonna? Afternoon. My name is David McElroy. I'm a professor of banking law at the University of Notre Dame. I'm also a visiting professor here at the Centre for Commercial Law Studies. Both of those are side hustles. My main job is as a barrister and head of Forum Chambers, which I set up just over 10 years ago, specialising in suing banks. And that's kind of moved on to suing cryptocurrency exchanges and fund managers, auditors, general professional negligence in the people losing money or being defrauded of money space. What I've been asked to do this afternoon is to talk to you about banks and their customers. The plan is to give you about 2 hours worth of content, and then when I've done that, we've got some problem questions that we'll work through in the last hour of our time together to see if we can ground and embed the learning that you've had. So we're going to start with 2 basic questions. The first of them is this: what is a bank? So in the 19th century, banking was primarily the issuing of promissory notes and trading in bills of exchange. So in 1833, there was a Bank of England Act which gave the Bank of England a monopoly over banking business within 50 miles radius of London. And London and Westminster Bank, that's one of the ancestors of NatWest today, opened up for business within that radius. Now, London and Westminster did not issue its own banknotes. It did not specialize in trading in bills of exchange. Instead, what it did was accept deposits from customers. And that was seen at that time as not being an infringement of the Bank of England's monopoly on banking business. By the late 19th century, in the Bills of Exchange Act 1882, which is still in force today, the Parliament defined a bank as a body of persons, whether incorporated or not, who carry on the business of banking. How helpful is that as a definition? It's not very helpful at all because, of course, it's circular. What is the business of banking? It's what bankers do. What do bankers do? It's the business of banking. But by now, 50 years on from Bank of England and Anderson in 1837, the business of banking has changed. And the reason why the business of banking has changed is because in 1844 and 1845, laws were introduced which restricted the issuing of banknotes by anybody other than the Bank of England. And the parallel development is in the USA in 1863, when during the course of the Civil War, the issuing of banknotes by private bankers disappears, and you end up with the greenback dollar that we are familiar with today. So what happens over that middle period of the 19th century is banks stop issuing banknotes and people start paying for things in a different way. And the way they start paying for things is something that, again, is obsolete technology for you today, but was all the rage for a couple of hundred years: the check. So what happens is people stop using banknotes so much, they start using checks. And if you are teasing away at the Bills of Exchange Act 1882 and trying to work out what the business of banking might be, you get to section 10 in the Act, which defines a check as a bill of exchange payable on demand drawn on a banker. So by inference, you can draw the conclusion that what the Bills of Exchange Act 1882 thinks the business of banking is it's about checks. And that continues to be the case for the best part of a century. So in 1966, the Court of Appeal in this country was faced with the question: was United Dominion's Trust a bank or not? Now, if you see something in the jungle that has two tusks, a very long nose, big ears, and is big and grey and making a trumpeting noise, what are you looking at? You're looking at an elephant. What if you saw something in the jungle that was big and grey and had big ears and a long trunk, but what didn't have any tusks? Still an elephant? So English law adopts what's called a central case approach to definitions quite often. And what a central case approach to definitions does is it says there are a cluster of features that define an elephant. And in any particular case, one of those features might be missing. But so long as you have enough of those features together, you can be confident that what you're looking at is an elephant and not a hippopotamus or a rhinoceros. So, when thinking about what a bank was, you actually, in that case, United Dominions Trust Limited and Kirkwood, get three different approaches to what a bank is from the three different judges. One of the unhelpful bits of the common law method, where you don't simply get the court speaking in one voice, as you do in many civil law systems. But what Lord Denning said was this, that the characteristics usually found in bankers were that they accept money from and collect checks for their customers and place them to the credit of their customers. And secondly, that they honour checks or orders drawn on them by their customers when presented for payment and debit their customers accordingly. And that those two characteristics carried with them a third, which was the keeping of an account in which the credits and debits are entered. So, still focused on checks, but now with the introduction of the idea of keeping accounts, keeping records of whether a customer is in credit, payments in, and payments out. Now here's the oddity about this case. Having given that definition, United Dominions Trust Limited didn't fit that definition. So what the Court of Appeal does, broadly speaking, is this. They go, United Dominions Trust Limited has been operating for 30 years. If we make the ruling that it's not a bank, that closes down its business. Everybody in the city has treated it as if it's a bank. So we're going to treat it as a bank even though it doesn't fit the central case definition. Now, what then happens shortly after that is the legislation comes in which addresses the problem, and so we don't have to move on. But what we've got here, as I think you can see, is over quite a long period of time, three different approaches to what banking is, none of which, I suspect, if I were to ask you, you would recognise as an accurate, complete, or even central case definition of what a bank is today. So, there was another way of thinking about banking that was put forward by Mr. Justice Isaacs, an Australian judge, in the case of State Savings Bank of Victoria and Permanwan Wright and Company in 1915. He said, the essential characteristics of the business of banking are the collection of money by receiving deposits on loan, repayable when and as or expressly or impliedly agreed upon, and the utilisation of the money so collected by lending it again in such sums as are required. What he then goes on to do, in the closest that judges get to poetry, is to start talking about how banks act like financial reservoirs, receiving streams of currency from all different directions into the sort of central reservoir, out of which then flow in all directions to sustain and fructify commercial operations. Basically what banks do is take money from people who have it and don't know what to do with it, and give it out to people who don't have it but do know what to do with it. And taking this kind of functional approach to what banks do. He says, look, all the mechanisms, all the techniques, all the instruments, all the products and services that banks develop are simply ways of achieving this basic function. So that is yet another approach to defining banks. Now, what then happens in England when the UK enjoys being part of the European Union is that the UK adopts a couple of banking acts, and then by the turn of the 21st century is thinking about banking in a broader financial services context. And thinking, well, hang on a minute, there are insurance companies that seem to provide accounts. There are institutions that provide payment services. There are lots of lenders. There are all sorts of different ways in which people are saving and investing. And so what we ought to do is just have a kind of broad picture where we think about regulated financial services activities. And so the idea that there is something special about banks or about banking gets seriously downplayed. And then the global financial crisis happens between 2007 and 2009, and suddenly it turns out that when the market turns, there's one category of institution that seems to have a special propensity to fall over and need rescuing at vast expense to the taxpayer, and that is the bank. So scrambling about, the UK decides it might be quite useful to have a specific definition of a bank after all. And so we get in section 2.1 of the Banking Act 2009, banks are a UK institution which has permission under the Financial Services and Markets Act 2000 to carry on the regulated activity of accepting deposits. So we've moved from trading in financial instruments through to checks, through to keeping accounts for customers, through to a kind of functional approach, through to accepting deposits. And I think the conclusion I've come to is that actually the things that banks do are they accept deposits, they facilitate payments, and they make loans and investments. And that really those three activities have been present in banking for the last 200 years. If my PowerPoint skills were better than they are, I would have either the triangle revolving, or I'd have those three things that are described revolving, because I think what we see is those three functions have always been there, but from time to time, it is different ones of those functions that come into the prominence of judges and legislators, because it's one of those three that is causing a problem. The question, I think, for you to have a think about is which of those descriptions is unique to banking? Is it accepting deposits that are unique to banking? Okay, it may be, but I wonder whether part of the reason why the banks were rescued in the global financial crisis is because not only do they look after people's deposits, they also are essential to the way in which payments are facilitated. Yeah. The thing that causes a panic and needs us to all rush around is not the fact that my long-term savings are potentially in trouble. We can work that out over time. The thing that causes a panic is I don't have the money to pay my rent. I can't buy groceries. And so you've got those kind of those. So that although accepting deposits may be the only thing that is unique to banks, their role in facilitating payments has been a powerful reason why they've been able to rely on the support of governments with so many bailouts over the last couple of 100 years. So if that's what a bank is, we then come onto the question, what should banks do and what should banks not do? So banks providing a wide variety of financial services is historically the German model. Why is it the German model? Geography and history. Germany sits in the middle of Europe. Germany took till 1871 to become unified. Germany has lots and lots of medium-sized cities where banks operated and provided all sorts of services because that was the sensible thing to do given the trade connections. In America, the Glass-Steagall Act, the deliberate mistake, not 1993, 1933. That prevented US banks from engaging in securities activities. Logic here, again, driven by geography. Very big country, lots and lots of small banks all over the country whose funds were ultimately going into the New York stock market, investing in companies that the banks had no way of really knowing whether what they were investing in was a good idea or what they were investing in was a terrible idea. It's a sort of financial crisis similar to the AI bubble that we've been told is coming. Some of these AI products are brilliant. Some of them are going to be market leading. We just have no idea at the moment which ones. So the US split investment banking, trading in financial instruments, in trading in corporate securities, from the activities of taking deposits and making loans, which are constricted to commercial banks. In the UK, we did not have a statutory prohibition on banks, commercial banks, ones that take deposits, engaging in investment banking. What we had was a functional distinction because as a matter of geography, again, the Bank of England in the City of London had very good relations with the institutions that began life as bill brokers and discount houses and became known as merchant banks. And then as mergers happened to produce the high street banks, they had these kind of two different lines of business. Just think about it in this sort of functional terms. As you know, the UK is an island. If what you were doing was looking outwards, going across the water, then it was the merchant banks and the international banks that were doing that. If what you were doing was providing domestically, then what you were doing was commercial banking, high street banking. Now, in 1986, we have the Big Bang in the city. All of that goes within a couple of years. All the merchant banks have been taken over by the high street banks. We have universal banking in the UK. But then we're back through the global financial crisis to the question, what should banks be doing? What shouldn't banks be doing? What should be bailed out? What shouldn't be bailed out? And so the Financial Services Banking Reform Act 2013 requires the largest UK banks, those with over 25 billion in deposits, to separate their core retail banking activities from their investment and international banking activities. So we now have what are called ring-fenced banks and non-ring-fenced banks. So if you wander around and have a look at all the sort of signs that are out in front of those bank branches that still exist, it's HSBC UK. And HSBC UK They added the UK when they set up the ring-fenced bank. So HSBC UK is the ring-fenced bank that is doing this kind of basic deposit taking, facilitating payments, lending kind of activities. And the stuff that's often described in derogative terms as the casino of financial services activities, those are all being carried out via the non-ring fenced bank. Now, try as you might, you cannot hermetically seal banks away from the rest of the financial services sector. So what we had running up to the global financial crisis was this idea we would have the sort of wide financial services sector with all sorts of activities going on and post the global financial crisis, there's a bit of a back off. Banking is seen as special once again. But one of the things banks like to do is to originate loans and then to sell the loan to somebody else. Because if you're a bank and you're able to sell the loan to somebody else, then you've got a pot of cash ahead of time, which you can use to go and originate another loan. So the old model of bank originates a loan, bank sits on the loan, bank waits for the interest to come in every month, and that's quite happy. That is seen as staid, as boring, and not as productive as selling the loan. So if you are a major borrower, you know that what's likely to happen is that the bank that gives you the loan is not going to be the institution that's collecting payments at the end of the day. But the attitude of the person who is collecting the repayments matters to you. You can have a good relationship with a bank and then find that suddenly your loan is being run by somebody who's much more aggressive, looking for any opportunity to call in the loan, apply default interest, all those kinds of things. So it's not uncommon to find covenants that try and strike a balance between the interests of the original lender, the bank, and the interests of the customer. And in the Argo Fund and SR Steel Limited, there was a transfer clause in this loan agreement. The transfer clause allowed the bank to sell the loan to somebody else. It allowed the bank to do it without the consent of the borrower, but the borrower's protection was that the bank couldn't simply sell it to anybody. What the bank had to do was sell the loan to another financial institution. So the question comes, what is another financial institution in that context? And the answer the judge in the High Court gave was that another financial institution had to share a number of common characteristics with banks. It had to be sort of bank adjacent or bank-like. So it needed to be like a bank in the sense of being a lender of money. It needed to be doing that in some sort of substantial way by way of business, so it needed to have a lending office as a way of doing it. It needed to keep accounts as evidence of money lent and the amounts due to be repaid. So echoing back to Lord Denning 40 years ago, the keeping of accounts is important. Though the judge said in that case, the financial institution doesn't have to keep its accounts of how much needs to be repaid in the same way that the bank does. It can use its own approach to that, but still needs to have that. And then it needs to have a recognised legal form and to carry on its business lawfully. So again, the customer is protected. It's no good the bank selling on the debt to a loan shark. That's precisely the sort of thing this clause is designed to protect. But that's an indication of the UK courts trying to arrange for an orderly secondary debt market to exist. Now again, if you take that and put that kind of definition of financial institution up against the three characteristics of banks that I identified earlier, the financial institution is definitely replicating what the bank is doing in terms of lending, but not replicating what it's doing in terms of taking deposits, and not replicating what the bank is doing in this particular case in terms of facilitating payments. So if those are banks, who are customers? Well, Great Western Railway Company in London and County Banking in 1901 is another example of this central case approach to definitions. A customer is someone who has an account with the bank. That's the central case. Or who is in such relationship with the bank that the relationship of banker and customer exists, even though at this stage they do not have an account. Okay, well, what sort of thing might that be? Well, let's imagine I have some family jewellery that is going to be used, come out at whatever weddings happen in the family. You can go and see a bank and I can say, you've got a safety deposit box facility. I'd like you to look after the family jewellery in the safety deposit box. That, I think, is probably likely to be seen as creating a bank-customer relationship. It's a different sort of relationship from the relationship in respect of an account. Query. What happens when I go to the bank and I ask the bank for a mortgage? And we go through an application process. And in the course of the application process, I disclose a whole series of material to the bank, and then the bank says, yes, you're approved for the mortgage. I haven't yet bought the property. I haven't yet found the property that I want. But I've got a piece of paper from the bank saying it's approved me for a mortgage up to a particular amount. Does that create a bank-customer relationship? So there are the various options that are there. The one that is difficult is this: payment services. If the bank provides me with payment services, am I a customer of the bank? The answer that was given in Great Railway Western Company was that if you went to a bank and cashed a cheque, that was not enough to establish a banker-customer relationship. And it's very easy to see that somebody who has an account, who is getting payment services provided as a consequence of having an account, should be seen as a bank customer. But what about somebody the other way round, who's on the other end of those transactions? The bank is providing a service just as much to the person who's being paid at the other by its customer as it is to its customer when it's receiving a payment. But it seems to be it would go too far to say that the bank was providing a service to the person at the other end. It's a different institution that is doing that. But then, of course, there are all sorts of prepayment cards and prepayment apps and so on that you can use. Do we see those as analogous with accounts? This feels like one of those areas where the law has been sort of stuck because nobody's come back to the question, as you can see, for 125 years. One of the virtues of the common law is, although we have a precedent-based system, the common law is supposed to, particularly in this area, respond to banking practice. And so it feels like this is an area where it's ready for a case to come up where the courts go, well, hang on a minute, let's just have another think about whether that definition that was provided 125 years ago is still fit for purpose, or whether we need to define things differently. Right, here's the question for you. What is the status of money in a bank account? So if you have been getting to grips with the wonderful way in which English law carves up questions of basic legal duties, you have the two that anybody from a civil law system will be familiar with: contract and tort, we call it in English, but delict would be what you'd call it in a kind of civil law system. And then you have a couple of oddities: equity and bailment. So bailment is nice and easy. Bailment is, says he, throwing a pen at Marcel. Marcel has now picked up the pen. Marcel is now the bailee of that pen. Bailment is all about the relationships that exist between two people when one of them is in possession of something belonging to somebody else. And English law of bailment is very, very flexible. It can include bailment for reward, which is where I say to Marcel, you've got that pen, please keep it safe. I'll pay you £10 if you look after it. It can include gratuitous bailment, where I say, Marcel, will you look after this pen for free for me? And he says, yes, I will. And it can include bailment of necessity, which is what's just happened, which is I threw a pen at him and Marcel picked it up because he knows he needs to give it back to me. So it's an extremely flexible remedy. The difficulty with bailment at the moment is that with bailment at the moment, the House of Lords in a case called OBG and Allen says bailment is only possible in respect of things that you can touch. So you cannot have a bailment of any of those legal rights that just exist in abstract or in the mind. Fascinating question for which I'm waiting for the right set of facts is, since we now have the Digital Assets Act 2025 with the creation of digital assets, the third kind of property, can we persuade an English court that digital assets are subject to a bailment? I think they should be. Professor Sarah Green of the Law Commission thinks they should be, but we're currently in a minority. But we're looking for a case to run that kind of argument. So you've got bailment as a possibility. The problem with bailment is this. Marcel's obligation as a bailee is to give me back the very pen that I gave him. So providing me with any one of these other black marker pens that are indistinguishable functionally from this, it would not be a satisfaction of his duties as a bailee. Now that's really, really, really useful in relation to the family jewellery in the safety deposit box, because it matters that that was my mum's jewellery and my grandma's jewellery and my great-grandma's jewellery. And the fact that somebody comes along and says, well, look, you know, I've 3D printed this jewellery and it looks exactly the same as what your grandma had, I'd still be going, no, that's not what I want. What I want back is the exact same thing. Now, does bailment sound like it fits, though, for the money that belongs to a customer in the bank account? Doesn't work, because I don't care whether I get physically back the same banknotes and coins that I put in. What I want is the value and equivalent amount. So, where might we go next? Well, where we might go next is we might go to tort. Problem with tort is that, generally speaking, English tort law is concerned, first of all, about people, personal injuries, and secondly, about damage to physical property. So the development of tort law in relation to the so-called economic torts really only happens in the 20th century, And the question about the status of money in a bank account arose in the 19th century. Now, you do see, in relation to banks and customers, questions of talk coming up. Sometimes you see questions about whether a bank or a customer has acted negligently. We'll see some of those as we go through. And you see sometimes questions about whether what a bank has done in relation to a payment instrument amounts to conversion. Conversion is a fancy word for an interference with the rights of the owner of that piece of property. But again, tort law doesn't feel like a particularly good fit for the status of money in a bank account. So where that takes us next, let's go and have a look at the law of equity and the law of trusts. Now, the law of trusts is a picture about where one person agrees to act for the benefit of someone else and to take care of that other person's affairs in one respect or another. And in some ways, this seems to work quite well. And sometimes English law will say, well, actually, when thinking about a bank-customer relationship, that kind of picture of trust or agency, which is kind of trust-light, works well. Two difficulties with it. The bank takes your money on deposit, pays you the promised interest, and then makes a profit from making using your deposit. Who keeps the profit? The bank does. And the problem with that is inconsistent with the fundamental principles of the law of trusts. Fundamental principles of the law of trusts will say if you are a trustee, then you have to hand over that profit to the beneficiary of the trust, and anything you want to keep has to be specifically identified and provided for. So you could end up with a situation where if you went back with that trust analysis, the bank would make a profit, you would get the profit less the bank's management fees. This is how, it's the basic principle of fund management is what you're seeing there. Second problem is that when you have a trust arrangement, the use the trustee makes of the money has to be either pre-approved by the beneficiary or has to fall within the generally recognized categories of what trustees of that type are expected to do with property of that type. I recently acted for a whole load of French investors who were deeply upset that the fund H2O Asset Management in which they were invested, instead of putting most of the money in safe shares and only a little bit in risky ventures, had in fact piled more than half of it into extremely risky ventures with a man called Lars Windhorst, whose principal qualities as somebody worth investing in were the amount of lavish entertainment he was prepared to show to the CEO and the chairman of the fund management business. So what are we left with? By a process of elimination, if bailment doesn't fit because it's far too restrictive, if tort doesn't fit because we're talking about money primarily, not about people or property, if equity doesn't fit because it's too restrictive, it would make bank business very tricky. What we are left with by a process of elimination, concluded the House of Lords in Foley and Hill in 1848, is debt. Money placed in the custody of a banker is, to all intents and purposes, the money of the banker, to do with it as he pleases. He is guilty of no breach of trust in employing it. He's not answerable to the principal if he puts it in jeopardy or if he engages in a hazardous speculation. He's not bound to keep it or deal with it as the property of his principal. But he is, of course, answerable for the amount because he has contracted, having received that money, to pay to the principal when demanded a sum equivalent to that paid into his hands. So the essence of the relationship between you and your bank, if you have an accounting credit, is that you are the creditor and the bank is the debtor. Having said that, it is a slightly odd kind of debt. So, historically, if you wanted the bank to repay the debt, you had to go to the bank's offices when the bank was open and ask for your money to be paid back to you. And unless and until you did that, the bank could hang on to the money. So, yeah, we're familiar with debts. Most debts that we engage require us as debtors to repay the debt by fixed amounts on fixed dates and fixed installments, and our obligation as the debtor is to go and find the creditor and make the payment. Yeah, banks historically were debtors where you, the creditor, had to go and find them in order to get them to repay the debt. And indeed, in early 19th century America, this led to the phenomenon of wildcat banking, where you would set up your head office of your bank in wildcat country, well away from any roads or railways, and you would just sit there and go, well, if you want to get my banknotes turned into gold and silver, yeah, best of luck spending 5 days hiking through the Wild West in order to get to me to get it paid. Now, in Joachimson and Swiss Banking Corporation in 1921, the Court of Appeal was forced to explain these departures from the ordinary law relating to debtors and creditors on the basis of the ordinary business and the custom of bankers. So this is picking up on two things that are features of English law. One feature of English law is the way in which English law in relation to banks and their customers tries to reflect banking practice. What English law is trying to do is to put guardrails around good relationships between banks and their customers rather than cutting across sensible commercial arrangements. The other thing it's showing you is that whereas some legal systems set up specific rules in relation to banking and in relation to banks, what we have with English law is English law tends to reach for an existing category that is somewhere in English law, but it's I'm sure you've all had this experience. You know when you're packing your suitcase to go to the airport and you've got a size limit or a weight limit, and you know how when you make your suitcase really, really full, the suitcase doesn't quite look the original shape that it did? That's what's happening here. That the concept of what a debt looks like that exists elsewhere in English law, the bank-customer relationship is being stuffed into this concept, and it's taking on a different shape because of the way the arrangements work. But this again, you know, I'm talking to you again about a case that's 100 years old. 100 years ago, if you wanted to get your money out, the bank could insist that you went to the branch where your account was held. Is that banking practice today? Nowhere near banking practice today. Yeah, it used to be the case that if you wanted to get your debt paid, you had to go to the bank branch whilst the branch was open. If you're anything like me, you've got half a dozen banking apps on your phone, and you expect when you're fed up with people on Christmas Day or whatever other holiday it is you're celebrating with your family that you don't want to be spending there, you can move your money around. And we've probably got to the point where if you're not able to do that because of some outage, you would want to complain that the bank isn't satisfying the terms of the agreement that you have. So again, we're in a position, I think, where despite the law of precedence, because English law is supposed to be responding to current banking practice. You could say actually the terms on which things are going, the shape of that stuffed suitcase is looking slightly different now from what it used to. What governs the relationship between a bank and a customer? We know that it's a contract. What kind of contract? Banking lawyers talk about the contract between the bank and the customer as a mandate. Now, I'm sure you've all had this experience. You've tried to open a bank account and the bank has said, would you like to come in and have a half-an-hour discussion about the terms on which your account is going to be operated? Of course, that isn't what happens. What happens is we are dealing with what civil law systems call contract of adhesion. It is take it or leave it. You are contracting with the bank on their standard terms and conditions. Now, given that you are contracting with the bank on their standard terms and conditions, what matters then is what terms have to be in there, what terms cannot be in there. The content of the contract must include those terms specified by the applicable English statutes. This is particularly important in consumer contracts, and in consumer contracts you've got two main sources for those terms. You've got the general consumer contract terms in the Consumer Rights Act 2015, and then you have the banking contract specific terms that are in BCOBs, that is the Banking Conduct of Business Sourcebook section in the FCA handbook. There are also statutes which contain terms that may be mandatory for some groups of customers and may be default terms, but ones you can opt out of in relation to other groups of customers. So an example of that would be the Payment Services Regulations 2017. Those are regulations derived from the second EU Payment Services Directive. The EU is currently debating the third EU Payment Services Directive at the moment. But there you have a set of terms which are mandatory for banks when dealing with consumers. But they are optional. They're simply the default terms for banks dealing with business customers. So if you get a contract that doesn't specifically exclude them, then they will apply, but it is open to a bank, if it wishes to do so, to exclude them in its standard terms. And then you have terms that cannot be included. The content of a contract cannot include terms which are unfair if we're dealing with a consumer under the Consumer Rights Act 2015, or unreasonable if we're looking at the Unfair Contract Terms Act 1977. And the Unfair Contract Terms Act 1977, which generally restricts the ability of a party to opt out of or to restrict or limit its liability for negligence, has wider application where one party is dealing with the other on the latter standard terms of business. That's section 3 of the Act, and that is where we all are in relation to our dealings with our bank. Now, the Payment Services Regulations also talk about the contract between a bank and its customer as a framework contract, and these contracts are long-term. If you are wondering why it is that banks were very keen to lend you money while you were students, it is because you are more likely to get divorced than you are to change your primary bank account. So, because of that fact, what happens is over the course of your relationship with your bank, one of those long-term lasting relationships that may be a forever relationship, you are going to find, as may happen in romantic relationships as well, that the terms have changed. The way that English law approaches this question is if you are notified of a change in the terms and conditions and you continue to operate the account after the new terms and conditions have come into effect, you are deemed to have accepted those terms. And generally speaking, you don't really get the choice about going back to the bank and saying, I'd like to stick with the old terms. Generally speaking, the choice that you get is you either continue with the bank on the new terms, the contract is treated as varied, or, and this is what the payment services regulations give you, you have the right to leave without penalty if the change is an adverse change and you go within a specified period, usually 30 days or 60 days after notice of the new terms has taken effect. So, as you've picked up by now, we're going to be grappling quite heavily with standard terms and thinking about the statutory restrictions on standard terms. Those statutory restrictions on standard terms are important in English law because of the limited extent to which English law will allow implied terms. So, English law takes the view that a term will not be implied into a contract simply because it would be reasonable for that term to exist. There's a case called Soraya and Douglas against Midland Bank in 1999. Soraya and Douglas were a firm of solicitors. What they wanted was a bank account which did two things. They wanted a bank account where they could make payments out of that account with a check, by check at that stage, but yeah, basically to make payments using a payment instrument, and they wanted to get interest on the money in that account. And what their bank, Midland Bank, said was, we offer two accounts. One account does the payment thing, the other account does the paying interest thing. So they said, all right, well, we'll have one of each. And so they had money in an account that wasn't accruing interest, and they had to make all the payments backwards and forwards. Shortly after they set up the account, the bank introduces a new kind of account which does exactly what the customer had asked for. 4 years go by before they find out that the bank has got this new kind of account. The bank had in fact adopted a policy during this period of telling its customers proactively about the existence of this new kind of account, but for whatever reason they hadn't been told. So they said, look, you know, the solicitor said it would be entirely reasonable for us to have been told about this. We've lost a whole load of money because we weren't told. It's not putting any burden on the bank beyond one it was quite happy to accept itself. And the court just said, I don't care. However reasonable, however favourable, however useful it would have been, that's not the test in English law. The test in English law is necessity. We're going to be done in about 2 minutes. The test of necessity requires one of two things. Either the term is necessary in order for the contract to make business sense. We need this to make this deal work. That doesn't mean we need it to make this deal a good deal for both parties. It's not that we need this to make a balanced deal for both parties. We need this for this to make sense at all as a business deal. Or the other way in which we imply a term is if it is so obvious it goes without saying. So this is if you were to imagine yourself at the moment the parties are doing the deal, and you are what's sometimes described as the officious bystander, the nosy Parker, the person who comes along at the moment the parties are doing the deal and says, what's the basis on which you're doing this deal? And both parties say, well, of course the answer is, it's obvious. So, for example, if there was some deal being done involving an arrangement to go out for drinks in the ship, If that deal is being done here with the Ship Tavern just over there, everybody would say, if asked the question, that's where we're going to be meeting for drinks, not that we're going to be meeting on one of the ships that's on the Thames, or a ship that's to be found in the Mediterranean, or a ship that's going to be in the Strait of Hormuz. The missing information is so obvious it didn't need to be written down because both parties knew in their heads the necessary context. It's not possible to imply a term if the matter is covered by an express term, and there is notoriously in English law no general implied term of good faith. Now, this is one of those really dangerous areas where the reality is that English law, for better or for worse, thinks that it doesn't need a general implied term of good faith because it's got a hodgepodge of different remedies that it uses to cover much of the space that implied terms of good faith cover in other jurisdictions. Well, that's taken us up to the first hour, so we'll now have a bit of a comfort break, and then we'll come back and carry on.
Not forget to record. Let's save the record.
Yeah, so I don't know how to...
That's going back again. We're just gonna go back all streams. Maybe not, but let's do that. Okay, there it is.
On the more.
I
think
it's
more.
not. It's more.
Yeah, more and then stop recording.
Yeah, stop recording.
Okay.
Yes.
Beautiful.
Lovely. Cool.
But we might want to check if that's fine. Do we use the mouse? So I think it's in the meeting summary. Yeah.
And
If we go back.
Why don't I'll let you drive then.
Let's try. Because there's. Let's do this. Where are you? Come on.
Okay, we have access to the cloud.
Access to cloud?
Maybe the AI, no?
Is it?
Because when we record it, it activates the AI.
I don't know. One second. Sure. One there. Docs. Where's the usually docs? Over here.
Here.
Here. Hub. Hub. It'll be in hub. And then it'll be right there. I think it's that one. That's today's.
No, it's January 27th.
January 29th. What's my meeting?
Today.
What is today's?
Meeting with recording.
Meeting with recording.
It takes a bit of time to process.
That is fair.
Cloud recording. Oh, 1
There
hour
you go.
ago. Yeah, that's that one, I think. Okay.
It's processing.
Yeah, just let me see. Because,
Yeah.
I ran a test earlier.
Yeah. If you just.
Yeah, process.
Now I can take my slides off here onto USB-C, but I can't. That looks like it's USB
Yeah.
A input.
Yeah, I think that's a challenge because if we have the recording and the slides together.
Yeah.
But I'm not sure if we're using your computer, the slides will be shared on that.
That's the question.
Yeah.
If not, what we want is the audio of that.
And then
and
you
then
layer it over.
yeah.
Yeah.
Hi.
Did you give us the code of attendance?
Well, not yet.
No, yeah, okay.
Alternatively, if your slides are on QM Plus, then you can.
They're not yet.
Oh, they're not
but
yet. No,
I can hand them out them.
that's
Happy to do that.
perfect. That was a great lecture.
Thank you.
It was a lot of fun. Yeah. Okay. Well, when that processes, would you like the attendance code?
Sorry?
Would you like the attendance code?
Yeah, go on.
All right. Set a file with it for a while.
Might as well use the pen I
Yeah.
threw at Marcel.
Okay.
Hi.
I wanted to ask about the bank and customer relationship that's
Yeah.
going to be tested in the exam. Are we looking at just solely the UK or US?
Just solely the UK.
Just solely the UK.
Yeah.
Okay. Because I think Megan mentioned this later, but there's also the PRA, the FCA that regulates. Are we going to
I don't. I'm not doing that today.
not today?
Not today. Yeah, we'll get to that at some point.
There you go.
Yeah.
IX, IJVM,
I X I
J, VN.
That's it.
Yep. No dash between the two letters.
There.
Yeah. There.
Okay.
Perfect.
Right. Shall we kick off again? Shall we start again? Do you want to start them? Set the recording up again.
Where's the?
If you start the banking law meeting.
Where?
Down there. Yeah.
Bottom right?
Yeah.
Oh, that one. Yeah.
that
Yeah.
one. Start that and then you can.
Start?
Yeah.
Wait, we are already in the meeting. That one. Where's the? Oh.
There you go.
Sure.
Yep. And then
Share screen.
so I left you on a cliffhanger about how there is no general implied term of good faith in English law. What we've thought about so far have been the restrictions that the courts might impose or that the law imposes on standard terms used by banks in their own favour. It's possible, of course, in theory, that the courts could imply terms into a bank customer contract in favour of the bank. Generally speaking, however, the approach that English law takes is that if a bank wants to put a customer under an express obligation, the bank needs to set it out in the contract. The courts are just as reluctant to help banks get terms that they want into their contracts as they are reluctant in general to help any party. So what you have is simply two implied terms which are recognised. That is, that you will not, as a customer, execute your written orders in a way which misleads the bank or makes forgery easy. So when you are setting up a payment to somebody, you are supposed to give their full name rather than just their initials. If I write a payment simply to IGS, then anybody who can come along and pick up that payment and say, well, I've got a legal entity called IGS, potentially could pay that in, and if I know that the payment I was supposed to be making was to International Gulf Shipping Limited, I should have put that information in. This was much more of a deal when you had handwritten payments by cheque than it is today. The other obligation that is there is that you will notify the bank if you become aware of fraud or forgery occurring on your accounts. So the idea here is that you are supposed to, from time to time, check your bank accounts. Yes, I've got a question.
So I want to ask on the first bit, which is, okay, I read it wrong because I thought it was the bank will exercise reasonable care as opposed to the customer. So my question was going to be, isn't that already like an established fiduciary relationship, or if it were the bank that was exercising reasonable care in executing the orders?
We'll come back to that. We will get to that point in a minute, and the question about whether banks are under a duty to exercise reasonable care when carrying out orders and what that looks like. But we're here talking about customers and customers' responsibility. In essence, what this is addressing is this question. The essence of a mandate is that the bank will carry out my payment instructions, so that if the payment instruction hasn't come from me, the bank should not be carrying out that payment instruction. The bank does not have authority to debit my account. So in what circumstances am I stopped from saying I did not authorize that payment? And there are two answers to that question. One is if what has happened is I initiated the payment, but the way in which I did so left it ambiguous to whom the payment was going to be made, or created an opportunity for a fraudster to come in and swipe it. So a classic example would be directors of a company who pre-sign checks and leave them then for somebody else in the business to make the payments. Or directors of a company who hand over the company credit card to somebody who is then not an authorized signatory to make payments. Or who provide the PIN codes that are needed to make payments. All those kinds of things, if you, the customer, are at fault and somebody else has taken advantage, well, you can't say, I'm going to use the bank as an insurer against my own fault. The second element is in relation to payments that have not been initiated by the customer, where the customer has not been involved, you are under an obligation to tell the bank if in fact you discover that fraud has been occurring on the accounts. Now, in Tai Hing Cotton Mill against Liao Chong Hing Bank Limited, the bank tried to say, this is a customer of ours, it's a business customer, which should be using its finance department to check the payments that are going in and out regularly, and the fact that it has not spotted payments that were fraud is the customer's fault. We should not have to repay. And the Privy Council said, no, a customer does not owe a bank a duty of care to take reasonable precautions in the management of its business, does not owe the bank a duty of care to check its bank statements regularly and to spot fraud and forgery. The duty only arises if, in fact, it spots fraud and forgery. Now, the banks did not like that decision, so they challenged it in a case called Price Meats Limited and Barclays Bank in 2000. In that case, what had happened was that £172,000 had been taken out of a business's bank account as a result of forgery. And the bank said we should not be liable because, one, there was some small-scale theft going on at this business involving what's called petty cash. So this is the sort of float of money that's there for buying donuts and biscuits and coffee. Court wasn't very impressed with that. They said, you know, people stealing biscuits and the money for biscuits is on a completely different scale from people stealing hundreds of thousands of pounds. You can't link those two together. Secondly, they said, we, the bank, had said to this business, your overdraft is getting very large, you need to look into it. So we'd prompted the customer to go and check what was happening with its bank account. And the fact that it didn't do so isn't our fault, we should not be liable. Mrs. Justice Arden rejected the bank's defence. They had another go, the banks, in a case called Patel and Chartered Bank in 2001. That came before Mr. Justice Tolson. This is what he said. He said, the argument a customer owes a bank an implied contractual duty to report fraud of which the customer does not know, but which a putative reasonable person possessing the same information as the customer would have discovered is unsound in principle and contrary to authority. Now, you know, of course, that the British sometimes have a reputation for politeness. That is a British judge being rude in a very polite way. When the judge says that this is unsound in principle, what he means is this argument is complete rubbish. It is a bad argument. And when he goes on and says that the argument is contrary to authority, he means not only is this a rubbish argument, it is an argument so bad that no judge, however stupid, would accept it. So banks have very limited abilities to impose implied terms on their customers. Because they're in control of the contractual terms on which we deal with them, the banks generally then have to put things in expressly or not at all. Now, it is quite common within the bank customer contract to have banks being given a wide amount of discretion. One of the big features of English law is long-term loans being entered into on a variable interest rate. So the bank is able to vary the interest rate up and down. And in general, the approach English law takes to that question is that the remedy for a customer who doesn't like the amount by which the bank has increased the interest rate is to leave the bank and go and refinance with somebody else. But that, of course, creates a category of customer who are either unable or unwilling to change lender, who then find themselves paying more interest. Nash and Paragon Finance says there is no duty on a bank to exercise any discretion reasonably. The duty is a negative duty, not to exercise a discretion for an improper purpose, capriciously, arbitrarily, or in a way that is irrational. Now, you had one line of authorities relating to banking contracts that start with Nash and Paragon Finance. There's another line of authorities in relation to bankers getting their bonuses that are supposed to be paid that are entirely in the bank's discretion. Those two lines of authority come together in Braganza and BP Shipping Limited in 2015. So that this kind of duty now is known as a Braganza duty. And it says that wherever you have a contract which provides that somebody has an absolute contractual discretion, that discretion will nonetheless be limited by concepts of good faith, genuineness, and an absence of arbitrariness, capriciousness, perversity, and irrationality. Now, again, the precise shape of that restriction will depend on what the express terms of the contract say, but the courts work very hard in appropriate cases to impose some sort of restriction on the exercise of discretion. Now, when Braganza came in, this led to a very fertile ground for lawyers like myself turning up in bank cases and saying that what the bank had done, the way the bank had treated my customer, was unreasonable. And so there's been some rowing back of this. Two kinds of light switch. There's the light switch you just turn off and on. It's either light or it's dark. Or there's the dimmer switch, you know, where you can turn it up and down. You can decide what sort of mood lighting you want. The way the courts have gone is the courts have said that this obligation not to act unreasonably applies to those contractual provisions that are like dimmer switches, where the bank has got a choice between a range of options. Then the bank is under an obligation not to act unreasonably or irrationally. But where you are looking at something that is either yes or no, black or white, on or off, then there is no scope for the imposition of this kind of duty. The English law will not control the decision by a bank, for example, to call in a loan repayable on demand. That's UBS against Rose Capital Ventures. So you now have a new kind of argument, which is that we, in these banking cases, go along and have an argument about whether what the bank has done is best categorized as the exercise of one of these binary choices, in which case the question of whether the bank has acted unreasonably or not is not something the court can consider, or whether actually what we're looking at is something that looks more like the exercise of a contractual discretion. And it is, in my experience, sometimes not at all obvious what the answer is, because often you get this kind of contractual decision to call in a loan is then followed up, well, what are we going to do? Are we going to enforce our security by appointing a receiver, by appointing an administrator? Are we going to enforce a personal guarantee? And so what looks like a sort of simple on-off choice can be categorized in a number of different ways. But this is one of the devices by which English law is trying to compensate for the lack of a general duty to act in good faith, and trying to find some sort of balance between the commercial realities that customers borrow money and banks are entitled to recover it, and the costs of enforcing when somebody hasn't repaid needs to be proportionate, versus what happens when some decision is taken that looks thoroughly uncommercial and perhaps even vindictive. Now, I painted the picture earlier about the bank-customer relationship as being this kind of contractual relationship, this debtor-creditor relationship. When you come and look at this in the context of litigation, what matters is whether you're looking at it in 2 dimensions or 3 dimensions. So when you're looking at it in 2 dimensions, the bank-customer relationship is seen primarily as this debtor-creditor relationship. But when we think about it in 3 dimensions, when we introduce a third party into the picture, then actually English law reaches for this agency analogy. The bank is the customer's agent for making payments or for receiving payments, and therefore begins to look like it owes the kinds of duties that agents owe when carrying out those kinds of transactions, including, in response to the question I had earlier, including a duty to act with reasonable care in and around the execution of the customer's payment orders. So this gave rise to a series of cases, including Philip and Barclays Bank, in which I appeared in the Supreme Court. A bank is bound to carry out its customer's mandate if it is given an instruction by the customer's agent that is within the agent's actual or apparent authority. So, company has a bank account. The company's bank account can be operated by authorized signatories, typically the directors of the company. If a director of the company gives an instruction to the bank to make a payment that seems to be within the director's authority, the bank has to process the payment. But if, for example, the bank knows that to process the payment would place the bank in breach of a mandatory provision of law. For example, if an English bank today were asked to make a payment to an account of a sanctioned individual, sanctioned as a result of Russia's war in Ukraine, for example, then the UK bank would be bound to refuse to carry out the customer's payment instruction. The controversy that took me to the Supreme Court was, what if even though the person making the payment is an authorized signatory, the bank knows that there's a fraud going on. Or the bank has enough information to suspect that there's a fraud going on. So all the way up to, in the Court of Appeal's conclusion was, if the bank knows that a payment instruction is a result of a fraud, the bank's obligation to take reasonable care requires the bank to stop the payment, not to make the payment until they've confirmed that their client isn't being defrauded. The Supreme Court took a different view. The Supreme Court's view was that if you have a customer who is being defrauded by anyone other than their agent, that is not the bank's problem. It is only if the customer is being defrauded by their agent that the bank should be intervening. So banks owe no duty to customers to protect them against romance scams. They owe no duty to customers to protect them against being contacted by somebody who claims to be from the FCA or the police and tells them they need to move their money to a safe account. All of that, the Supreme Court says there's no legal duty to protect. The only protection that exists is for companies where one of the directors who's an authorized signatory is defrauding the company, or for somebody who was given an attorney, a power of attorney over their account, and the attorney is carrying out a fraud. Interestingly, in the Supreme Court, a lot of time was spent talking about a case called Ryan and Bank of New South Wales, and then the Supreme Court then completely ducked this particular question. Because in Ryan and New South Wales, Bank of New South Wales, the judge in that case said, look, imagine that you are an agent asked to deliver a parcel to number 44. And you go to number 44, and when you get to number 44, you see that number 44 is on fire. Should you still deliver the parcel? And to pose the question is to answer it. It's obvious that even though your instruction was to deliver to number 44, to take our officious bystander again and ask the question, what would the person who gave me that instruction want me to do if they knew what I know, which is that number 44 is on fire? And the answer is, obviously, I wouldn't deliver the parcel. So it seems to me that the outcome of the Phillip case ought to have been different, because the Supreme Court ought to have analysed it in this way, that although the customer has given a mandate, if the reasonable banker knows that the account holders would not desire their orders to be carried out, if they knew what the bank knew, then that would be a justification for not carrying it out. It's one of those things where I spoke recently to one of the judges in the Court of Appeal. He still thinks they were right. I still think they were right. It's one of those decisions that was made, I think, in the Supreme Court on policy grounds, because they were thinking about the cost to the banking industry of getting involved and being exposed to greater liabilities for preventing fraud, which is a major issue. Let me run through briefly different types of bank account. The current account, withdrawals on demand, payments to a wide range of other accounts. That's the kind of classic account that the Foley and Hill analysis of debt applies to. Deposit account, same thing in terms of legal analysis. We're talking about an account which typically pays a higher rate of interest. Withdrawals may be subject to notice or conditions, but it's still the same analysis of debtor-creditor. It's just there are specifications on when you can demand repayment. Sole account's really easy. You have one individual account holder who may appoint an attorney as joint signatory. Joint account, two or more account holders. You can have an arrangement with two or more account holders where both of you have to sign before any payments go out. That would be a very quick recipe for divorce in my household. If I had to be present and co-signing every time my wife was spending any money, or if she had to be present and was co-signing every time I was spending any money. If you don't have that, you are both liable if one of you spends money on the account. As Mrs. Fielding found out, her husband was a partner in a law firm. He'd managed to negotiate with the bank an extension of their overdraft from £250,000. She knew about that. He walked it all the way up to £3 million. And she tried to turn around when he was made bankrupt and say, I'm not liable for that because I didn't know about it. And what the court said was that actually it was a joint account. Any one of them could incur a liability under that account. And what she needed to do if she wasn't happy with the extensions on the overdraft was inform the bank no further extensions without my consent. This thing about joint accounts is really, really helpful. If you have a payment that is to be made into a joint account, and it is to be made into the names of both people who are named in the joint account, a payment made into a different account in the name of only one of them is not a valid payment. So I dealt with a case in which a divorcing couple were involved, and the wife moves out, and the husband sold their house without his wife's notice. He received a cheque written to both of them, and he paid that cheque into an account in his sole name. And after lots of running around by other lawyers who were trying to sue solicitors for professional negligence and all sorts of other bits and pieces, I said, there's a cast iron claim against the bank here. Really simple. That cheque had to go into the account in the name of Mr. and Mrs. And it didn't. We wrote to the bank and they paid up immediately without us needing to issue proceedings. And then a corporate account, which is an account in the name of a legal entity giving a bank a mandate to act on the instructions of authorised signatories. All of these are examples of that debtor-creditor relationship. Overdrafts. Rule number 1. A bank does not have to give a customer an overdraft. You may have discovered this yourselves. Rule number 2. If a customer is allowed by a bank to go overdrawn without express agreement, the overdraft is made on the bank's usual terms and conditions. Basically, every time your account is going to go below zero, a bank has a choice whether or not to honour a payment. If it refuses to honour the payment, you can't complain about it. If it decides to honour the payment, then you are necessarily getting stuck with whatever its usual terms and conditions are as to charges and interest for that. And that's quite a big deal because in practice, if you have an account in credit in England, you get a subsidy because you don't have to pay charges because all the charges are whacked onto people who have overdrafts. This is one of the great ways in which the middle classes are subsidised by the working classes in England. Unless the bank agrees otherwise, an overdraft is repayable on demand. But you can go and see a bank and ask to arrange an overdraft. If a bank expressly agrees an overdraft, then instead of the line at which the bank gets a choice about whether or not to make payments being at zero, it's at whatever the level of the overdraft is, 1,000 or 2,000 or whatever it is. The bank must honour payments up to the limit of the agreed overdraft. And you can talk to the bank about having an overdraft that is in place for a specified period of time, 3 months, 6 months, or whatever, in which case that overdraft will remain in place unless there's some provision in there allowing the bank to terminate it early or on demand. So again, contractual analysis, but it's all by negotiation. Now you could have, as a result of your relations with the bank, a number of different bank accounts. You could have, for example, a savings account. You could have a current account with an overdraft. You could have some form of long-term loan. Although as a matter of accounting between you and the bank, you can have multiple accounts. Were you to become insolvent, or were the bank to decide to enforce its rights against you in the event of default, banks have the right to combine accounts. So in this example here, you've got one account in credit to the tune of 6, one account in debit to the tune of 2, one account in debit to the tune of 10. The bank can offset the credit against the debits so that it becomes a creditor in your insolvency just to the extent of the net balance. This is a way of banks getting ahead of the queue when a customer becomes insolvent, because they don't have to put all of the credits that they've got into the pot to be shared out amongst the general creditors. They can simply offset them against liabilities that are there to the bank. Why do I tell you that? I tell you that because of this. In addition to the kinds of accounts that I've already been talking about, there are trust accounts. With a trust account, strictly speaking, the relationship between the account holder and the bank is still that of debtor and creditor. But if the bank is on notice that the account holder is a trustee, then two things are happening. The bank knows that the account holder owes duties as a trustee in respect to the funds in the account. So starting to ask those questions about, is this payment that's being made for the benefit of the beneficiary of the account? That will be something the bank will have to think about. And secondly, the bank cannot combine the funds in the trust account with the debts owed by the trustee in their own right. So if you're a trustee looking after funds on behalf of other people and your own finances are dodgy, you want to notify the bank that some of the money is there being held on behalf of children or on behalf of others. Now, all of this was tested in a case called Barclays Bank and Quizclose Investments, which was, when I was studying, an extremely difficult case to understand. I think it's got a bit simpler now. What happened in this case was this. Rolls-Razor was a company in financial difficulty. It owed a lot of money to its bank, Barclays. Now, Rolls-Razor had a customer, Quizclose, who wanted Rolls-Razor to make some products for it. But for Rolls-Razor to make the product, Rolls-Razor needed supplies. So what Quizclose wanted to do was to pay for the supplies, but didn't want the supplier to know that Rolls-Razor was in trouble, so the payment had to come from Rolls-Razor. So a new account is opened. Quizclose makes the payment into that account. The idea is that payment is going to be used to pay the suppliers. The suppliers will be delivered to Rolls-Razor. Rolls-Razor will then make the goods and send them back to Quizclose. That doesn't happen because the minute the payment goes in, Barclays takes the payment, exercising its right to combine accounts. So the question that arose was whether this kind of arrangement should be recognized by English law as an example of a kind of trust account arrangement. And if so, what was the nature of that trust? And the way in which the House of Lords in that case decided that this was a kind of purpose trust arrangement that it was lawful, that it didn't violate the general rules on priorities in insolvency, because what's happening in this kind of example is that new money that Rolls-Royce wouldn't have had is going in. And so the other creditors aren't being prejudiced by this money being ring-fenced in a separate way. But the way in which it was analysed wasn't very well explained. None of my law lecturers could explain it to me. And it took until 2002, in the case of Twin Secker and Yardley, for Lord Millett to explain it in terms that make sense. What Lord Millett said in that case was that what we're looking at here is a resulting trust. The lender pays the money to the borrower by way of loan, but he does not part with the entire beneficial interest in the money, and insofar as he does not, the money is held on resulting trust for the lender from the outset. The borrower, in this case Rolls-Royce, has very limited use of the money, being obliged either to apply it for the set purpose or to return it. So, really straightforward. Rolls-Royce is the trustee, Chris Close is the beneficiary. It's just that unlike a normal resulting trust where the beneficiary says, give me my money back, under this arrangement, what Chris Close is saying is use my money for the purpose that I've agreed that you should use it, or give it back to me. And that's the picture, which frankly makes a whole lot more sense than the way it was explained to me. I've said a number of times that banks, generally speaking, are not to be regarded as trustees. If you are extremely fortunate to generate enough money to get into a relationship with a private bank, then you will find that the banks will be happy when acting as fund managers to act as trustees. They're not trustees or fiduciaries unless they've expressly agreed to do so. But those banks that hold themselves out as having the skill and expertise to carry out the specialised business of trust management or fund management will be subject to the standard of the reasonable banker possessing such specialised skill and ability. So it's the standard rules in relation to professional negligence that you are held to the standard of the person, the reasonable person in the area you're operating. Account closure. You heard the phrase debanking? So the phrase debanking is a phrase that's cropped up over the last 15 years to describe circumstances in which people suddenly find that their bank accounts are being closed. There have tended to be two different types of debanking. In September 2013, the BBC reported it had heard from more than 100 people from ethnic minorities in the UK whose bank accounts had been closed without explanation. Now, probably what that meant was that the banks were engaged in something called de-risking. They looked at the account holders in question, looked at the countries that they came from, and said, right, we don't want to take the risk of being associated with money laundering, and so people from these particular backgrounds, we are simply not going to offer them bank accounts. So that's one group of people who've experienced debanking. The other group of people who've experienced debanking are people who express personal or political views that the bank does not want to be associated with. So the British National Party is a racist party in the UK. In 2004, there was a television programme exposing the racist attitude of members of the British National Party. Following that television programme, Barclays announced that it was closing the party's accounts, taking account of the reputational risk to the bank of continuing to operate the account. In October 2016, Margarita Simonian, the editor-in-chief of Russia's state-run broadcaster RT, formerly Russia Today, announced that NatWest had closed all their accounts at the London branch. They'd received a letter saying, "We've recently undertaken a review of your banking arrangements with us and reached the conclusion we will no longer provide these facilities." And that closure not just only infected Russia Today, but also affected its senior staff working in the UK. And then in 2023, it was announced that Nigel Farage, the Reform politician and architect of Brexit, had had his accounts closed by Coutts, which is a bank that's part of the NatWest. So, what are the rules in relation to account closure? The rules in relation to account closure are that banks should let customers leave if they want to, and that a bank cannot require an individual customer to give more than 1 month's notice before the customer closes their account. As I mentioned earlier, these are long-term relationships. If the bank changes its terms and conditions and does so in a way that's adverse to the customer, the bank should allow the customer to leave without penalties. But so far as the customer is concerned, if your account is overdrawn, then unless the bank has told you that the overdraft is in place for a specified period, the bank can close your account on demand. Banks are not required, unless they expressly agree to extend credit in those circumstances. So you're only protected from an account being closed if the account is in credit. Now, under the payment services regulations, in respect of accounts for individual customers and for those business customers where the bank hasn't opted out of the payment services regulations, the minimum notice period that must be given is 2 months. So that gives you 2 months to try and organise an alternative account. In respect of accounts for individual customers opened on or after the 28th of April 2026, I'm not suggesting you should all close down your accounts and open new ones after that date, but you might want to think about it. The minimum notice period is increased to 90 days, and the customer must be provided with a notice giving a reason, an explanation of the reason for termination. Now, there's a slight nonsense about all of this last bit here. The slight nonsense about this last bit is there's an exception to giving an explanation of the reasons for termination. So if the bank would be committing a money laundering offence by tipping you off that you are the subject of a money laundering investigation, then the bank is excused from giving you an explanation. But if the bank closes your account and doesn't give you an explanation, the only explanation as to why they haven't given an explanation is because you're being investigated for money laundering, which is the one thing they can't tell you about, which is why they haven't given you an explanation. Yeah, this is, again, one of these nonsenses. You know, when we go back to think about what a bank is supposed to do, a bank is supposed to comply with your instructions strictly unless it's got a reason not to do so. And the only reason it's got not to do so that it can't tell you about is that it can't tell you that you're suspected of crime. So anybody who's actually been involved in criminal activities for more than 5 minutes knows that the minute their account gets frozen or a payment instruction isn't processed or they're told that it's being closed down, it's because the police are looking into them. And so they can take the evasive action which they would take it in exactly the same way as if the bank had simply said, well, I'm sorry, the reason why we can't take any further action is because you're being investigated. Well, that leaves us with 4 minutes for questions before we have another break, and then we'll be back for some problems to try and work out how all this applies in practice.
such a scenario?
So the circumstances in which you would go after individuals at the bank as opposed to the bank itself was deeply, deeply unclear until there was a Supreme Court decision last year which sort of sorts out the law in relation to attribution. And basically, rough sketch would be if you are accusing the directors of fraud or dishonesty, then the fact that there's a company involved or a bank involved does not provide the directors with a shield against personal liability. That's the thumbnail sketch for it. Yeah, so that
I was thinking along the lines of suing the directors for breach of director duties.
the only people who can sue the directors for breach of directors' duties are the company. The duties are owed to the company. And even if the shareholders sue, the shareholders would sue, you would sue in the name of the company, you'd bring a derivative action. The way in which this most commonly arises is company becomes insolvent, liquidator takes over company, and then the liquidator sues the directors who were running the company before the insolvency for breach of directors' duties. Yeah. Yeah.
From this question, does that imply that maybe the Supreme Court is trying to say directors should be held accountable for the fraudulent acts that they do, as opposed to maybe dragging the bank in, since the bank will not is not required to stop a transaction simply because they understand that the fraudulent activity is going on.
What the Supreme Court was doing, I think, in that case, was thinking in particular about circumstances in which customers are misled and enter into contracts because of lies that have been told to them by bank officials. And in those circumstances, if a director tells a lie to a bank customer, the court says, well, the director should be personally liable as well as the bank for that. If a director sends out a salesman or a bank manager, knowing that the salesman or bank manager is going to say something to the customer, which the director knows is a lie, then again, the director should be personally liable in those circumstances. Now, I've got a case on at the moment involving a banker who switched from one bank to another on the basis of what he was told about the new bank's cost of funding. And he says the people who spoke to me and told me about the new bank's cost of funding were telling lies because they knew that actually the bank's cost of funding was much higher than the one that they told me. If they told me the truth, I'd have realised I wouldn't be able to do my job when I went to work for that bank because we'd never be competitive. Great, well, if there are no more questions, let's have another break and then we'll come back and we'll have a grapple with some problem questions, apply what we've seen so far.
The college list they have, it's possible no colleges.
Yeah.
Can I bother you for a second? The IT service hasn't renewed my MFA authenticator, so I can't put my attendance manually. I'm having every teacher put me in manually from their phone. If you could.
I don't have the app either, so
I don't?
no.
No worries. I'll just talk to someone else.
Yeah.
Thank you.
I have to go because I have a dean's colloquium judgment.
Okay. Fair.
But that was great.
Okay.
If you need anything more.
Do you want to take with you for your delectation the questions? So you can have a think about
That would be perfect. Okay.
it.
Thank you so much.
No, pleasure.
Have a lovely day.
Thank you.
Everybody should have done now.
Can we get some more? Yeah. I don't have any. Yeah.
Sorry. I was just wondering, you said that the slides for your lecture are up on QM Plus.
Yep.
Will they be made available
Yes, they will.
on QM Plus?
Yeah, they will. Yeah.
That's just it. Thank you.
So, question 1. What sort of account have George and Henrietta Jackson got? Joint account. So, what does that mean?
Whatever happens on the account, George and Henrietta need to know whatever happens.
So they're both going to get copies of the bank statements or access to the bank statements. What is going to be the document that governs the terms of that account? What do we call the contractual document? Yep.
The mandate.
Mandate. Okay. What do we know about from the facts that you've got in front of you about the terms of the mandate? On this occasion, the blank face is the right answer. We don't know anything. You've not been told anything about the terms of the mandate. So what are the options? Yeah.
We can assume that it's the standard terms of the bank.
Okay, standard terms, yeah. Which are likely to say what?
For example, usually they put interest on overdraft.
Yep, so we're going to have, there's been interest payable on the overdraft, yeah. What's happened in this case? Yeah. The overdraft's increased. Who does it look as has benefited from the overdraft increasing? George. He looks like. What does it look like George has done?
Robbed Daphne.
He hasn't robbed Daphne. Daphne's the bank manager, who's just conveniently ended up in the same country as George, having caught the same flight as George.
Oh, sorry, he's robbed Henrietta.
He's robbed Henrietta. It looks like he's cheated his wife and run off with his bank manager. That's what it looks like. So, if you are advising Henrietta, yes.
Is it like similar tax to the case you said? So unless there was specific terms in the mandate that required both of them to sign to agree to extend the overdraft, then potentially, even though she didn't know that it was extended, it's still like doesn't matter.
Yes, so we need to see the mandate, but the default position is likely to be that either her or her husband can extend the overdraft on the joint account. And if that is the case, then we are looking at a scenario where she is liable for the increase from £10,000, which she did know about, to £500,000 that she didn't know about. Are we comfortable with that being the analysis? We don't like this. What claims does she definitely have here? Yeah, I'll take you again and then I'll come back to you, Melissa.
The money that's gone into the account that's solely in George's name, because that money cannot legally go into an account without her name.
No, if the standard mandate is there, there's nothing she can complain about there. Yeah. You'd need to go back to the terms of the mandate, but on a standard mandate for a couple, for a married couple, you'd probably be looking at a situation in which one signature is enough. So she's exposed. She might have a beautiful claim for an indemnity against George. And then I think we're back to the question that was being asked just before the break about personal liability. Because who else might she have a claim against? Yeah.
The bank. Because the bank is responsible of checking if the transfer has been made to an account that has both names instead of just one.
Well, that would depend, wouldn't it? Yeah, I have a number of investment accounts, deposit accounts. Some of them are in my name because I need to get the money back out again to pay tax. Some are in my wife's name. So money goes in and out of our joint account into accounts in both our sole names. Why is that a problem? What would you need to point to suggest that the bank ought to have asked some questions? Yeah?
Isn't it also on the origin of the money? Because it's almost half £1 million, and it cannot come from anywhere. So since it comes from the overdraft of the joint account and it's transferred to a single account at George's name, it's likely suspicious to the bank.
So we're sorry. Yes.
So I was going to say, considering that most of the transactions would have been put through their relationship manager, Henrietta can raise a claim seeing that Daphne has cut a flight with
George.
so she could raise an issue to say that in terms of, for want of a better word, the fiduciary relationship of the bank to protect whatever George and Henrietta had, simply because the transaction would have passed through the relationship manager.
Okay, let's pull the threads together. A bank does not owe any duty to stop transactions that look normal. So what you would do if you were advising Henrietta is you would say, look, there are a number of things that look unusual about this. Number one, this is an account where up until now £10,000 has been quite enough by way of overdraft. So suddenly we've got a massive jump from £10,000 to £500,000. That looks unusual in and of itself. The second thing that is happening is that money is being transferred to an account in another country. Generally speaking, the banks in England are more relaxed about transactions between accounts with banks in England because it's easier to get the money back because it's still within the sort of English banking system, the English legal system, than once the money's disappeared out. And thirdly, then you would be saying, okay, it's also unusual that the money is being moved from a joint account into a sole account. You know, if the figures were the other way around, if there's £500,000 in the joint account and £10,000 is being transferred into a sole account, who cares? You know, that's just makes perfect sense for a couple to organise their life like that. For suddenly them to be taking on £500,000 jointly and the money to be a large amount of money to be disappearing off into one place is the sort of thing that you would, as a bank, say the bank should be asking questions. But you've got in this case the additional fact that we're not actually talking about a transaction where the question is, should the bank have asked some questions? It looks pretty strongly, doesn't it, as if there's somebody at the bank who knows the answer to these questions. Who's the person who knows the answer to these questions? Daphne. Daphne knows the answer to this question. She's arranged the overdraft. Why she arranged the overdraft? She's arranged the overdraft to finance her new life in the Middle East with George. So when you see that, you say, okay, this is one of these circumstances where actually, when we're looking at it, it's not just that Henrietta should be able to sue her cheating bastard ex-husband, but well, soon to be ex-husband and his new girlfriend. But it's a case where actually the bank as an institution not just should have known, but did know that what was happening was a fraud. And so you make the bank vicariously liable for the fraud that Daphne has committed in the course of her employment at the bank. We're feeling a bit happier about Henrietta's legal position now than we were a few moments ago. Yeah?
Shouldn't the bank have notified Henrietta that national when this guy took the overdraft and then transferred it to sold account? Shouldn't bank have notified Henrietta at all? Yeah. So basically, when this guy took the overdraft, should bank have notified Henrietta that George took this national money?
They should have done as a matter of practice. They're not required to do so as a matter of law when the overdraft is taken out. The transfer out, you could make the case that say that in relation to the transfer out, they should have done, but it will depend on the terms of the mandate, because these facts are deliberately extreme, and the situation is that actually you rarely find mandates tend to say either we've always got to tell you, or we've got to tell you if it's above a certain amount, or we never have to tell you, and it will depend on what the mandate says, which of those three apply. Yes.
I have a question. I'm just trying to understand what would be the damage or the loss experienced by Henrietta in this case. My understanding is an overdraft basically is a borrowing.
Yes.
Right. So if there is this unauthorized amount of borrowing, what loss does Henrietta experience aside from just, why is it the claim just, void this transaction, at least from my perspective, Henrietta's perspective, that she will not be liable to the 490 and then just call it a day?
Well, that is what she's looking for. Yeah, that would be what she would be looking for. What she would be looking for is for the bank to say, we are not coming after you for the 490. You're still jointly liable for the 10,000. Yes, you have to be put back in the position you would have been in if that void transaction hadn't applied. So the bank will have a claim against George for the 490, but that makes sense because George has had the benefit of the 490, whereas Henrietta hasn't had any benefit out of the 490.
I think, sorry, you mentioned earlier about an indemnity claim against George.
Yes.
And what would that look like?
Well, if Henrietta had not been able to avoid the liability to the bank, she would owe the bank the 490, but she would be able to get back the 490 by an indemnity from George. Yeah.
So there's no problem with the increase of the overdraft from 10k to 500k, but there's a problem because George is the only one benefiting from that 490k. Is that correct?
Yes, because if the bank was prepared to increase their joint liability to 490, then unless Henrietta had already before that happened said, do not increase the liability.
So because she hasn't said that, there's no problem with increasing it to 490.
No. Yeah. Now that's the bank taking a view that they're a good credit risk for 490. Yeah. Okay. How about the next one then? So what are we? If the first question was taking us into thinking about joint accounts, what's the second question taking us to think about? can hear various people whistling. And those of you who were saying under your breath, you can say it out loud now because you were right. Trust. Yeah, we're looking at trust accounts here. So we've got two accounts. Well, in fact, we've got three, haven't we? So we've got Mr. Trusting has got an account in the name, which is actually being held on behalf of his son, Stephen. Got another account which is held on behalf of his daughter, Ursula. What's the difference in the position between the two of those accounts? Yeah.
Is it the fact that it doesn't tell, like it fails to tell them that the money in the other account is from US dollar?
Okay, so what's the significance of that then?
I think that the account will be taken to be the resulting trust for the bank.
Not quite. Yeah. They assume it's his. Yes. So in relation to us, that's terrible. In relation to the money in this account here for Ursula, they assume that that money is his, whereas in relation to the account in the name of Stephen, Mr. Truss's name, but on behalf of Stephen, they know that that is Stephen's. So, when Mr. Trusting gets his overdraft, which of those accounts is vulnerable to the bank applying its right to combine accounts? Yeah. Yeah. So this one here, the bank assumes that's his, so the bank is thinking, we will give him an overdraft, and if something goes wrong, we know that we can't set off the money that is in this account, because even though it's in Mr. Trusting's name, we know the money really belongs to Stephen, but this one over here looks like his. Now, he's of course, Mr. Trusting may be getting an overdraft, or getting an overdraft for the amount that he's getting it, because the bank assumes it's got assets in that other account that actually belongs to Ursula. So, we're going back a little in time, but he's offered an overdraft on terms that the overdraft is repayable on demand, but will be reviewed. What does that mean? Two options. Option one, this is an overdraft that is repayable on demand, full stop. Option number two, this is an overdraft that is guaranteed to remain in place till the 30th of September. Yes. You think it's guaranteed to be in place till the 30th of September? Who else thinks that? Who thinks it's Sorry, yes.
Does it mean that repayable on demand full stop, but then the amount might be reviewed on 30th of September?
Okay, you think that? Yeah, hi.
Does it mean that it will be asked to pay it before the 30th of September? Or
Okay, so you think again it's repayable on demand? Yeah. Okay. So the room divides. Well, you're in good company in not being sure what this means, because the Court of Appeal, when faced with this wording, split 2-1. The majority said the words on demand mean what they say. That what this means is that the bank is saying, currently, our intention is to give you an overdraft that will remain in place till the 30th of September, but we're reserving the right to change our mind at any moment, in which case we could ask you to repay on demand. So that's, yeah, there's a sort of non-legally binding expression of the bank's current thinking, and then the bit that matters, the bit that has legal force, is the words on demand. That was where the majority went. The minority said, no, actually what this meant was that the bank thought that the overdraft was in place until the 30th of September. Now, this takes you into the wonderful world of interpretation. The only thing I can tell you about what the words of a contract mean is they mean whatever the Court of Appeal say they mean. Even if, as in one case I was involved in, none of the lawyers or the judge of the court below thought that the interpretation the Court of Appeal applied was the right interpretation. I think the borrower was slightly unlucky in that particular case, because there is something called the contra proferentum rule, which is a rule that says if a document is ambiguous, if you can't decide which way the coin falls, which interpretation is preferable, you apply the interpretation that is against the person who wrote the document. So, originally, overdraft, repayable on demand, 10,000. 20th of April, Mr. Trusting asks Mr. Insincere for an increase to the overdraft of 15,000. Mr. Insincere agrees to increase the overdraft and tells Mr. Trusting he has 2 months to bring the overdraft down to £10,000. Two questions. Question number one. As a result of that communication from Mr. Insincere, what is the amount of overdraft that the bank has agreed to give Mr. Trusting? 15,000. And so what happens if Mr. Trusting makes a payment which is not going to take the overdraft beyond that 15,000 limit? Yeah, he will have to pay it back, but the bank has to honour that payment. So Mr. Trusting has got a £15,000 overdraft. If he makes a payment that takes him beyond 10,000 but still under 15,000, that is a payment that the bank has to honour, because Mr. Insincere has said that that is the amount of overdraft that's there. Next question is this. What do the words 2 months to bring the overdraft down to £10,000 mean? Yeah.
Does that mean he has to pay like 5,000?
Yeah, he will have to pay £5,000 within 2 months' time. Yeah. Yes.
So if after those 2 months' time he tries to make a payment that is forced, like, and it would bring the overdraft to 11,000, the bank wouldn't have to honour it because they've agreed that after those 2 months it needs to be.
Yeah, if after those 2 months he made a payment that took it over 10,000, the bank wouldn't have to honour it. The bank could still choose to honour it, in which case it would be giving him an unagreed overdraft, unauthorised overdraft. But that would then be the bank's choice. It's not something he could expect as of right. Yes?
In those cases, will they change their original contract, or will just leave it as
It depends. Often banks leave it, because often you find things like the interest rate on your unauthorised overdraft is 30%, whereas if you'd gone and negotiated with the bank for an authorised overdraft, the interest rate on your authorised overdraft would have been 10%. So in some circumstances, if banks think you're going to repay the money, it will suit them to have it as an unauthorized overdraft. From a customer's perspective, you are almost always better off going in and agreeing the terms of the overdraft in advance. Yeah.
Can I just check something in practice? Would the banks require consumers to put in some collaterals if there is an increase in overdraft?
They might, but the reality is that they will. A lot of this is done by data analysis now. So the banks will use AI and other tools that will analyze your spending habits and look at it and go, okay, this is a seasonal spend because Mr. McElroy has just gone on holiday. And he usually has an overdraft for 3 months after a holiday. And once he's paid off his bar bill at the end of 3 months, then his account comes under control. So we're not going to worry about that. Or actually, no, I can see that quite a lot of the payments that have been made in casinos recently. And I'm not actually sure that the money is going to be repaid. There will be all sorts of credit scoring things that will be being used to work that out. Question I have for this side of the room, since you're all being very quiet at the minute, is this. Does what Mr. Insincere has said change the time when Mr. Trusting has to repay his overdraft? Yeah.
Yes, it does.
You think it does? Why?
Because it's very like specified. Like he has 2 months to bring the overdraft back to £10,000.
Okay, so that means, do you think that means then that the bank is now, Mr. Insincere on behalf of the bank is now guaranteeing that Mr. Trusting has got an overdraft in place for 2 months?
Yes. Also, it is mentioned that it will be reviewed on the 30th of September, and the bank will further, as in Mr. Insincere will further instruct Mr. Trusting about the timeline of the overdraft.
So you think that combination of things overrides the fact that the letter said it was on demand? Okay, you were going to say
Yeah,
something.
I was just wondering if that was like a binding, if we could consider it as a binding variation. Like, could possibly Mr. Insincere did that in regard to because how did he say it? Did he say it in writing? Like, you have only 2 months to bring your overdraft down to 10,000? Like, was it initially like prescribed that the bank has this? Because otherwise, if someone calls me and said like, "Oh yeah, you have like this limit, but you know what? You have 2 months to like bring it down to 10,000," and if I wasn't prepared for that and I didn't actually see it initially when it was opening my bank account with them, then how would that possibly work that one way that just wouldn't be the position? So I'm just doubting that this possible.
I think you're on some really good lines there. So the starting point would be what we're told is that Mr. Insincere told Mr. Trusting he has 2 months. The implication of that phrasing that I used there was that this is oral. This is done over, as you say, during a telephone conversation or a face-to-face meeting. Now, whether that has any effect or not will depend in part on whether, under the bank's standard terms and conditions, variations of contract must be in writing. So if the bank said, actually, the terms between you and us are written terms, and any changes to those written terms has to be in writing, then the oral indication by Mr. Insincere may not have any contractual effect. Now, we're in interesting territory here, because on the one hand, English law likes certainty and promotes and will uphold clauses that require written variations so that everybody knows where they stand. On the other hand, banks routinely record phone calls. You know, and we're moving into an era now, aren't we, where, you know, AI transcriptions of meetings and so on are available, so that the need for a written-only variation clause, because we don't, otherwise he said, she said, who do we know what said? That's sort of disappearing, because we've got these kind of independent records that we can now look at. Yes?
So in addition to what you said, I think whether or not the mandates explicitly says variation of contracts should be in writing, considering that Mr. Trusting did not approach the bank directly to request for the increase in the overdraft, does that not contradict or does that not set aside the express need to say, oh, if he had requested in writing for the extra £5,000, then there would have been a follow-up saying pay back in 2 months. Considering that they've moved outside the original agreement, does that not play a role in this scenario?
So what you're saying, I think, is there's what's written down in the contract and what happens in practice. That the no oral variations clause that's in the that may be in the mandate is a clause that's there for the bank's benefit. And the bank could have insisted, Mr. Trusting, we're not going to consider an oral request for an overdraft, you need to put it in writing and we will respond in writing. And the bank, having chosen not to do that, has in effect waived the oral variation clause.
Yes, but I'm saying with regards to Mr. Trusting waiving his protection that would have come from having a written contract, simply because he asked for the increase orally, considering that it says he asked an employee of the bank and not the bank directly.
Well, you can't, yeah, but the bank directly doesn't exist. The bank, you can't ask a bank. Well, I mean, we get to the point with AI that you might be able to. But generally speaking, what you're doing is you are asking an agent on behalf of the bank a question. So I don't think that runs. I think a court would be keener on requiring the change to be in writing if it were adverse to Mr. Trusting than it would if it's favourable to Mr. Trusting. So I think where that takes us to on this question is Mr. Trusting was entitled to ask Vulture Bank to make the payment to Wonderland Limited. That the bank ought to have made that payment. You've got a reasonable argument if you're Mr. Trusting that the demand of the repayment of the overdraft is premature, but ultimately at some point, whether it's now or in September or in 2 months' time, he's got to find the money. Stephen's money is going to be protected because the bank is on notice, and Mr. Trusting is going to have to go and apologise to Ursula if in the end Ursula's account gets taken. What you would hope to do if you were Mr. Trusting is get round and tell the bank now, whilst raising these points and saying you've got to wait another 2 months before you can ask me to reduce the overdraft. Tell them about the existence of Ursula and the fact that the money in that account belongs to her and not him. So Careless Bank, which opens an account for it's Negligent Bank, which opens an account for Mac Mafia Inc. Any issues with what negligent bank has done?
That's negligent bank giving an account to my bank, yeah, demonstrates a failure of KYC.
Yeah, there's a big KYC failure, isn't there? What are the red flags? False address, yes. Nominees, need to know some more about that.
Illegal business.
Yeah, well, they've said that their business is international cyber security solutions. It looks as if Negligent Bank hasn't done any checking whatsoever to see if that is actually, I mean, yeah. As it happens, international cybersecurity solutions being used here is a euphemism, and it's a euphemism for ransomware attacks. Is what's happening. So let's move from there to Careless Bank. So Careless Bank has given a couple of accounts to Generous Limited. What's happened? What's the first thing that's happened to Mr. Hardluck?
Gets his debit card stolen.
He gets his debit card stolen. Okay, debit card has been stolen. He's spotted the theft. What's his next problem? He can't report it. So, based on what we've done in this lecture, what are we thinking about in relation to the failure to report or the inability to report?
He would be said to have breached the reasonable care he has to prevent fraud from happening to his account.
Well, his answer to that would be, I haven't. I'm not in breach of an obligation. I took care. I spotted, as soon as I spotted the fraud, I tried to let the bank know. Yes?
The bank failed in their duty of care.
The bank failed in their, what's their duty of care?
So I think there should be a form of safety for their customers. So I think they failed to provide like an accurate medium for their customer to be able to report the fraud.
Okay. So that again. Well, the bank is not liable for the initial loss of the card. The bank, as part of its contractual obligations to Mr. Hardluck, would, I think, today be held to be under an obligation to provide a 24-hour helpline for victims of fraud. I think that's one of those things. If you said, let's have a look at banking practice today, all of us, every piece of plastic, every app on our phone gives us a line, a number to contact wherever we are in the world. If we need to let our banks know that we've lost our cards or had our wallet stolen or phone taken or watch or whatever it is that we use as our payment device. And so, therefore, if anything happens after the time that when that initial report was tried to be made by Mr. Hardluck, then he's saying, well, actually, the further losses I've suffered, the use of the debit card to buy the flights online to Russia, that shouldn't be on me. Because if you, the bank, hadn't been in breach of contract by failing to provide me with the means to report, I would have reported, this payment would not have gone through. So what's the effective cause of the the further expenditure. It's not the initial loss of the card, it's the bank's failure to provide with an effective means of reporting it.
But if it's not provided for the statute for the bank to provide this 24-hour hotline, could the bank then argue that it's not liable for it because the statute doesn't require me to provide a hotline?
The bank could argue it, and that would have been a great argument in the 20th century. It's you know, if I were presenting this case on behalf of Mr. Hardluck and Generous Limited, I would simply be turning up, and I've done this in cases where you just have page after page after page of examples of terms and conditions of other banks. And you'd say, there's American Express's 24/7 hotline. Here's HSBC's 24/7 hotline. Here's BNP Paribas's 24/7 hotline. And you would just put it all together, and you would then call an expert who in the banking industry who'd worked in fraud and say, what's your experience? And he'd say, even startups like Revolut, Monzo, and Starling have got a number. It may not necessarily have a whole bunch of people taking action on it 24/7, but it's there for collating the information and automated responses happening. And we haven't looked at it in this lecture, but there's also then a whole bunch of regulatory stuff about systems and controls where banks are supposed to have backup systems in place, so that if the phone centre in one location goes down because of some issue, there's another phone location in another place, or there's an automated message that says, I'm sorry, we can't report it by phone, but please use the app or whatever. That you'd run those kind of arguments. And again, what I touched on in this lecture was the way in which English law is responsive and adaptive to banking practice. They're not the courts are not trying to impose on banks additional obligations that ordinary competent banks don't assume. But if ordinary competent banks are behaving in a particular way, then the courts will impose liabilities on other banks that are falling short of that. So that then takes us to Mischief. Mischief, an agent of McMafia Limited, she gets a job in the finance department at Generous Limited and transfers £2 million in 200 separate transactions, each of 10,000 over the course of 5 days, to McMafia Inc.'s account at Negligent Bank. Why do you think she picks £10,000 as the amount for each of these transactions? Yeah.
It's maybe just under the limit where there are red flags that are raised.
Absolutely. She's picked a number where she's going, if I move 2 million in one go, they'll stop this. If I just do it in 10,000, I can, eat the elephant bit by bit, mouthful by mouthful. Yes.
It's also a transaction monitoring failure on the part of.
Yeah. So it's a transaction monitoring failure by careless. What do you think? What should have been triggering them to take action then? Yeah.
And do they have, and the tagging for saving school fees, IT security, and miscellaneous, all comes from one company.
Yeah.
So is that company, what's the relationship of Generous and McMafia?
Yeah. So how would you put it together? What's the biggest red flag out of those four, do you think? School fees. Right, school fees. I mean, a very small number of people in the world who have 50 children, all of whom need £10,000 of school fees paid at the same time. So the school fees should be the trigger that there's something going on. Once you've done that, the first thing you should be doing is putting a block on the account. Even if you're not putting a block on the account, you then have a look at the next lot of transactions. What would be the next lot of transactions that would concern you? Maybe, or miscellaneous. What's the miscellaneous? If the school fees I'm suspicious about, I need some explanation. What's the real narrative underneath the miscellaneous? Once you've asked those questions and haven't got satisfactory answers, this whole account ought to have been blocked and closed down. And this is the sort of oddity. Yeah.
Do banks here have the power to suspend transactions?
Yes. Yeah, they do. And the courts are very. The way that the line has been drawn in Philip is to say, under the general law, the decision that the bank has to make is either I'm suspicious, I'm stopping it, or it's fine, it's going ahead. And if the bank says I'm suspicious, I'm stopping it, the courts are not going to impose liability if the bank's suspicion turns out not to be justified. In fact, banks routinely write into their terms and conditions something that says, we will process your payment instructions promptly unless we have suspicions about fraud or financial crime. So the bank has got an express contractual right to delay payments. There has been some discussion about whether the law should build in a delay to payments. Yes?
Which is very interesting. I know we're doing the questions, but I just want to know when you're not answering, because right now we're identifying the issues and the sort of solving the problem. But when you're not writing in the exam, you're actually answering what structure is expected that actually constitutes like a great response to the question.
With problem questions, I think it's go through line by line or sentence by sentence and tease out whether there's anything significant in that sentence or line in terms of building up a factual picture.
Okay, so for instance, the second question, it had a lot of information that wasn't really necessary, that wasn't really like the idea of Ursula's account. We weren't really addressing that in terms of Mr. Trusting, the part we were advising Mr. Trusting, right? Do we have to include what we think just to mention, like her standpoint, if she was to probably get into some liability of some sort, or is only strictly to address the question and picking the things that the elements that address just the question?
The key to this is going to be usually the sentence at the end that tells you. So on the second question, you're advising Mr. Trusting. So you're looking at things from Mr. Trusting's perspective primarily. That's how you're doing it. So here, in relation to the third one, you're advising Generous Limited. You're talking from that perspective. You'll get told in most of the questions whose perspective you're supposed to be looking at. So if it wants you to look at multiple perspectives, then you'll be given that as an indication. Right, well, you can play with question 4 on your own time. Thank you very much.
So sorry, can I just check for question 3, the negligent bank?
Yeah.
My answer initially was to allow them to open a bank, but to give them notice for closure thereafter.
No, I think basically they shouldn't have allowed them to open the bank in the first place. Yeah. Hi. I can't. I don't have access, so you have to let the usual teachers know. What's your name? Okay, I'll do that. Thank you.
Is the Zoom meeting over?
Yeah, I stopped it. You can check that.
Sorry, I think I missed the class attendance call.
Did you?
Well, it was up on the board.
It was
It's
there.
there.
It's there on the other one. Yeah.
Sorry, just a short follow-up to my
Yeah.
question regarding the suspended transaction. So you mentioned that this is usually contractual stipulation.
Yeah.
But this is not yet like embodied in the law where it is mandatory for all banks to do that in case of some changes.
In relation